Good morning, everyone. It's a pleasure to chair and discuss this session on macroeconomics, productivity, financial inclusion, and market power. These three topics are they are directly related. They are directly related to the structural changes that we are facing in the MENA region today and beyond. So, what these three papers are connected is not just their empirical scope or their regional focus, but their deeper concern, which means how do we design macroeconomic policies, not just for growth enhancing, but also how to make them inclusive, sustainable, and resilient to shocks. So we'll be talking about three papers today. The first paper, looks at market power and the role of regulatory innovation, including unconventional tools like the value-added tax. The second paper will investigate fiscal sustainability under uncertainty, and the third one explores how financial inclusion can become, based on the information and communication technologies investments, how it can become a pathway to equitable growth. The format we'll be following I will first let our speakers, present their papers. Then I will the second paper by Dr. Yamout, she couldn't be able to join us today in person, but she sent a video of the presentation, so we'll be looking at it after the first paper. And the third paper, unfortunately, they couldn't join us in person and couldn't also provide a video, but nevertheless, we will discuss this paper also. And I will do that in the end. So we'll first listen to our speakers, and then after that, I will present a discussion presentation, and then I will not only look at the three papers one by one, but also I will highlight their contribution, their methodological approaches, and their key findings and policy implications, and then briefly draw some comparisons across the three papers and look at where they intersect or diverge, and also pose a few questions to the authors and also to the room. Right? So, okay, let us start with our first paper by Mr. Tohamy, who is a PhD student, and this is part of his dissertation study, actually. So, and a very interesting one also. So, please, the floor is yours.
So I have the mic, so thank you. Thank you very much. Thank you very much, everyone, for coming, and thank you, Dr. Abdullah, for introducing me. I am Ahmed Tohamy. I'm a PhD student at the University of Oxford, and this is joint work with two of my colleagues from when I was at the fund, Yevgeniya, Korniyenko, and Weining. Weining is actually an economist for Laos and Vietnam at the moment, while Yevgeniya is one of the economists for Egypt. So if you're Egyptian and you're looking at the IMF people, she's one of the team. So this is a project on corporate market power, broadly speaking, in the Middle East and Central Asia. So we kind of study the trajectory of the concentration of market power and to what extent we can draw lessons from the experience of the Middle East. Now, kind of the theme or the motivations for this paper are a few. So the first is market power over the last 30, 40 years globally has been increasing. We see that across multiple papers. So you have kind of papers by De Locker et al. In 2020 in the QJE, other papers by Autor et al. Kind of looking at other measures as well. And then for other countries, you have papers like the S. The kind of finding is broadly the same, this kind of increasing trend of market power. This is US data. And what is measured on the y-axis, although not reported on this figure, is a kind of price to marginal cost ratio. So if you think kind of basic microeconomics, if we're in a competitive environment, the price to marginal cost ratio ought to be 1. Deviations from 1 above 1 are indications of some concentration and firms kind of extracting rents from customers. Okay, so we see this trend. This is a US listed company data set. It's spiraling out of control, right? So the question is, do we see the same trend in the Middle East? And the second question is, given what we know about the region and given kind of the portrayal of the region historically, do we think that this trend is higher, perhaps the starting point is higher in the Middle East than it is in the US? So that's kind of the second part, the second motivation, that the Middle East is uniquely seen as uncompetitive. You have papers by Chaudhry, you have obviously Why Nations Fail, kind of speaking massively about the role of institutions and rent seeking in the region, etc. But then you see this also kind of dissipate in policy discussions when you look at kind of IMF reports. There's always a sense in which we should encourage competition and encourage competitive or antitrust authorities in order to strengthen competition. But actually, that's the question. Is it true that we have data on the extent of market power in the region? The third motivation is that post-2020, there's a rising, obviously, wave of global inflation. That hasn't translated much, especially in the Gulf Cooperation Council economies. And so the question is, can a markup squeeze during this period, could it explain the extent to which there was no great inflation in the Middle East? The final question that we're interested in, broadly speaking, is the idea of whether value-added taxes could be used as an additional policy lever by the state in order to reduce the extent of market power. And this is kind of a slightly unorthodox tool. There is evidence for it, and we're going to discuss that. Okay, so kind of our contributions are, broadly speaking, to study Middle East market power during this period from 2000 to 2022. Our main finding is that, just as a preview, that markup measures in the Middle East are higher, but they're declining. And towards the end of our period, so say 2022, we'll see there's actually kind of not that much difference between them and the US. Part of that is that the Middle East markups are falling, but also part of that is the US markups are increasing. We also discussed kind of an alternative markup measure, and so we are going to explain it in a second. And then we study kind of the implications of the introduction of value-added taxes in the Gulf Cooperation Council, and also we study the impact of inflation and market power, this interaction between the two. Okay, this is kind of the outline of the presentation. So kind of the idea is we're trying to identify this price to marginal cost ratio. And you might tell me, Ahmed, how do you identify a price to marginal cost ratio? You never, in firm level data, in kind of financial data sets, you never actually observe price and you never actually observe market marginal cost. So how are you going to identify either? So then kind of this is the methodological interest. So for a cost minimizing firm with variable costs given by S, we can show that this markup measure is actually a ratio of two objects. The first of them is the elasticity, the output elasticity with respect to the input S. So that's if I increase an input by 1%, how much does output increase by? Divided by the ratio of expenditure on input S to total revenues, to total sales. This is quite a general first order condition. It applies under kind of multiple deviations. So if you have fixed inputs, if you have fixed costs, this finding still holds. Okay, so now we can identify exactly what the expenditure is. We can identify what the revenue is. That's something that is available off accounting and finance databases for firms. But what we can't immediately identify is the output elasticity, theta, right? Theta IT. So there are two approaches to identifying this data. One is the econometric approach. So I take a regression with the input log S, so log of the expenditure on that input, against log of revenue, right? And with a bunch of controls, with time fixed effects, with firm level fixed effects. And I fix that parameter theta for a subset of my firms. Those could be the same industry, or they could be the same industry within the same time period, or they could be varying across industries or varying across time periods, right? So now the benefit of doing that kind of, and I'm not going to go through the derivations, is that the main benefit is that we don't need to assume constant returns to scale, because I'm estimating what that coefficient is directly. Now the cost is I'm assuming that this parameter is constant across a subset of firms. So the input elasticity or the output elasticity with respect to an input for, say, Apple is the same as Vodafone because they're in the same industry. That's an assumption I'm making. Okay. Now another assumption which is slightly more technical and involved is that I'm also assuming that the revenue elasticity is exactly the same as the output elasticity. Now you might say these are not different things, but obviously there is a price parameter that features in the revenue that doesn't feature in the output. The output we hope to achieve removal of a price endogeneity problem, which is usually present in these settings. Okay. Now the other approach is essentially if I place an additional assumption, which is constant returns to scale, I can exactly identify what theta is for a specific firm. Okay? That's a firm level theta. So I don't have to assume that it's similar across a bunch of firms, and I don't have to assume no heterogeneity between firms. Okay? The cost is I'm assuming constant returns to scale, and that assumption is not entirely valid. So kind of these two approaches are complementary, and I'm using both to show evidence for the same finding. Okay? Okay, so what data set am I using? I'm using CompuStat. So this is a panel of listed companies forming kind of consolidated accounts of these companies. So these are kind of firm financial data sets. And we're starting from the year 2000 to 2022. We're speaking about 13 Middle Eastern countries. And so we get around a 1,300 firm in an unbalanced panel. Kind of cleaning, we don't do that much cleaning in order to make sure we have as many firms as we can, because one of these exercises requires a lot of data. So it's very data intensive because we're running that regression across multiple industries, hoping to kind of reduce it so that the theta is for a small set of firms, right? So we kind of use what is common in the literature, but we don't do much more. Okay, so let me kind of jump. One kind of major criticism that we keep receiving when presenting this paper, and I'm sure Dr. Abdullah will say the same, is to what extent is our sample representative of the economies in the Middle East? So our sample is a sample of listed companies. So these are kind of the largest firms in an economy, the firms that are listed, the firms that employ a lot of people. Can we extrapolate this to say this holds for the entire economy? Our findings hold for the entire economy. So we have here kind of a measure of sample representativeness. Broadly speaking, this ranges between around 5 percentage points, earnings as a fraction of GDP, and in some cases it goes up to 100% in some of the economies. We also see this broadly rising kind of across the period that we're studying. So we're not worried about saying we have a substantial fraction of these economies. At the same time, we've been thinking about expanding the sample in other ways, but say by looking, for example, at small and medium companies in, say, the enterprise survey by the World Bank. Okay, so let me kind of jump to the facts because I've bored you with a lot of discussion on the theoretical background. The broad finding is that there's a reduction in the trend for markups. So over the last 20 years or so, by both measures, on both measures, we see a reduction in markups. Depending on the measure, obviously, the size is different and the fraction of that is different. But this is true across both measures. The cost share, which I described in the econometric method. Okay. Now, this is kind of a map of these markups averaged between 2010 and 2019. And we see kind of Gulf economies having a higher share than the surrounding ones. We see Morocco having a high share, and we see Kazakhstan up there. Now, the history of inclusion of Kazakhstan was that in the IMF, the classification includes Central Asian economies, which also includes Kazakhstan. So that's why we have Kazakhstan included. Okay, so let's look at kind of a relative comparison to the US level of markups. Now we're starting from the year 2004, so this huge spike in the US we don't see in these figures, but it exists in the background. We see kind of both the rest of the Middle East and the Gulf cooperation economies, their markups falling, and we see a slight trend upwards in markups for the US. And so by the end of the period, there's kind of a closing of the gap, even though at the start there is a gap between the Middle East and the US. Now, this finding is also replicable if we look at kind of firm level dividends. So firms in the Middle East are issuing less dividends. That's kind of usually also historically seen as an indicator for the extent to which there is market power. This is the other measure that we've described. So using the assumption of constant returns to scale, and we see exactly the same finding broadly. Markups in the Middle East are falling, and in the US, they're slightly rising. This is kind of another measure. So this is a measure of concentration. It's called the Herfindahl-Hirschman Index, and that's kind of measuring out of the sales to what extent are the sales formed of one company in an economy as opposed to multiple companies. And the same broad finding holds. Kind of US market concentration is on the lower end, but there's kind of a closing of the gap. Now, another finding is that the Middle East has a kind of superstar firm phenomena. So larger firms exhibit higher markups. And so if you look at kind of ignoring the yellow dots, so these are oil and mining, and they have their own special trends that they follow, especially in the Middle East with OPEC. You see the other industries have a rising trend as you increase the sales. So bigger firms are more extractive or more extractive of rents. One kind of immediate concern you might have with respect to my data is, given that there's a lot of entry and then given that listed markets in these economies are expanding, that it might be that because firms are entering into my sample, the average markup is falling. And these are new entrants, they're weaker firms, and that's why we observe this reduction in trend. So we kind of conduct an accounting decomposition, and we actually find that most of the reduction in markups is happening through within firm reduction. So this is the same firm having a reduction in its markups. It's not that we have, for example, new entry that is leading to lower markups. And in fact, if you look at the net entry figure, so had all of the markup changes occurred only due to net entry, we would have seen a higher markup. Okay, this is a breakdown by countries. I guess let's leave this for a discussion if people are interested in specific countries. And this is by sectors, and I'm happy to go through each, but let me skip it for the interest of time. So in this exercise, we're looking at kind of what's the impact of an additional 1 percentage point shock to inflation on our measure of markups. And this is kind of to elicit this idea of has a markup squeeze led to no inflationary wave during the 2022 period and the 2020 period in the Gulf cooperation economies. And kind of the backdrop is that a lot of the fund economists, when they were interacting with country authorities, they were being told that there is a kind of specific way we manage inflation in our country, which is through interaction, and we kind of tell businesses not to increase their prices, and they listen. And so we see that actually. So if you look at shocks to inflation and how they affect markups in Gulf cooperation economies, we see that there is a kind of contraction in markups in response to inflationary shocks. But in non-Gulf countries, we actually see no response. So kind of non-Gulf economies retain the same level of markups, and they pass off on the entirety of the price shocks that they receive to their consumers. Whereas in the Gulf, they squeeze their markups. Okay. This is kind of excluding the 2020 to 2022 period in order to avoid any COVID concerns that overlap. So this is kind of just pre-COVID data. We see this evidence. This finding is robust to kind of tons of different control variables, fixed effects, thinking of time fixed effects and thinking of other measures, and kind of we're plotting the impulse response function over a 5-year period. Okay. Now the final aspect of this presentation, we're discussing this value-added tax reform and introduction since 2016 in the Gulf Cooperation Council. So Gulf Cooperation Council economies have agreed to adopt a value-added tax in 2016. And it was a framework agreement. They agreed the rate during that agreement, so 5%, and they harmonized the entirety of the kind of legal jargon so that they can implement it also across borders within their council. So starting 2018, in fact, some of the economies adopted and implemented the tax, but some didn't. And so that's kind of the variation that we're using to say the adoption led to two groups, one group that is treated, firms that had their markups affected and firms that didn't. Okay. Now, the mechanism that we're thinking about for this impact is that value-added taxes are affecting the demand curve of the final consumer. And so if there is a tax on the final consumer, we should observe that the point where the demand meets supply is different and such that markups could fall. Okay. Now, the assumption for our identification strategy of this impact to hold is that had the countries that didn't implement the value-added tax actually implemented it, we would have seen a similar response to the ones that did. Okay. So this is kind of a value-added tax table across countries and across years. And so we see kind of 2017, everyone is at 0. 2018, the year that they promised to adopt, we see the UAE and Saudi Arabia first in line. They're eager to diversify their oil revenues, and if that's the history of adopting. 2019, we see Bahrain also adopting. And then Kuwait and Qatar and Oman actually continue not to adopt. But then 2021, Oman also adopts. And then interestingly, Saudi Arabia and Bahrain, who were kind of very excited by the non-oil revenue that the government is now generating, decided to go full board and double, in the case of Saudi, triple their value-added tax, actually in some instances contrary to the advice of what the IMF was saying. And so these are kind of the changes in the tax rates that we're trying to use to identify the impact on markups. So kind of this is the headline difference in difference figure. So we see that in the years prior to the reform, we satisfy a test of the parallel trends. And the idea is had there not been a tax increase, we would have seen parallel trends continue to hold after. But what we actually observe is after the introduction of the tax, that there is a reduction in markups. And so this is kind of an additional policy lever that can be used by policymakers. Skip this. So kind of let me just finalize. Markups are higher in the Middle East than in the US. They're kind of on a downward trend, and they have been closing up with the level of the US. So maybe perhaps the kind of historical views of international organizations when approaching the region should be adjusted and adapted to this new reality. It's not the case that Tunisia should worry about market power more than the US. We see kind of highest markups in oil, mining, and utilities, and we see kind of a concentration among larger firms. We also discussed the other markup measure. This is kind of important in this literature for more technical reasons that maybe I shouldn't discuss at the moment, and I'm happy to discuss later in the discussion. And we're kind of rehashing a discussion of value-added taxes as part of the optimal policy mix to deal with antitrust and to deal with inducing competition. And yeah, that's it. Thank you very much. I'm happy to show you other things.
Thank Dr. Tohamy for his presentation. Now, yeah, we thank Dr. Tohamy for his presentation. Now, the second paper in our session is called Fiscal Limits in the MENA Region by Nadine Yamout. Unfortunately, she wasn't able to attend the conference in person, but instead she sent a video recording of her presentation. Now we'll watch this presentation now. This paper makes a valuable contribution by extending the fiscal limits framework by 2012 study, which is an important study, into a regional context of MENA, which is badly needed but rarely applied in this region. So its main idea is quite powerful. Fiscal space is not just a fixed debt to GDP ratio. It is like a rather probability distribution, and that reflects not only economic fundamentals but also political capacity and institutional capacity. So this is very interesting. So let's
Okay, thank you to the organizing committee for including this paper in the program. Unfortunately, I couldn't be with you today, but I very much look forward to receiving your feedback, comments, or suggestions on the paper. So I'll be presenting fiscal limits in the MENA region, a structural analysis of debt sustainability. So the idea is that economies of the MENA region has faced unprecedented socioeconomic as well as political shocks over the last decade or so. Middle-income MENA economies witnessed widespread uprisings starting 2011, which demanded political and economic reforms, but resulted in periods of political instability. So with the humanitarian and refugee crisis that has been created out of these uprisings, they had repercussions in terms of tourism revenues, foreign direct investment, as well as deteriorating public finances. For oil exporting MENA nations, including those in the GCC, they also saw their fiscal balances worsen starting 2014 due to the decline in oil prices. And more recently, COVID-19 struck the region at a period where several of its economies were already struggling to recover from protracted downturns and structural fragilities, basically. So as a result, the financial situation of MENA countries' public sectors has become a major concern for policymakers in these economies, because they have been running high budget deficits, which resulted in the accumulation of sizable sovereign debts as shown in this figure here. So against this background, this paper examines how the fiscal fundamentals of some selected MENA economies and the economic shocks that they face affect their fiscal space. And here the fiscal space is defined as the maximum level of sustainable debt net of their actual debt as a share of GDP. So for this purpose, what I do is I employ a nonlinear DSGE model that incorporates a state-dependent fiscal limit based on by 2012. And I extend this framework to capture the different revenue structures of oil exporting and non-oil exporting MENA economies. Now, the fiscal sector is calibrated and the parameters underlying the shock processes are estimated using data from 6 non-oil exporting economies. These are Egypt, Jordan, Lebanon, Morocco, Tunisia, and Turkey, as well as 6 oil exporting economies, which are Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the United Arab Emirates. And using this framework, I basically examine 3 things. First, how macroeconomic and fiscal fundamentals of the MENA economies drive their fiscal space. Second, how shocks to productivity, to public spending, and to government revenues affect the distribution of the fiscal limit. And third, how different fiscal policy actions regarding transfers and taxation affect these economies' debt sustainability prospects. Now, in terms of the literature, I think of this paper as being connected to two strands of the literature. The first is that which assesses the dynamics of the macroeconomy in the presence of a state-dependent fiscal limit, and the prominent example is by 2012, who derives basically a stochastic fiscal limit that arises endogenously from a dynamic Laffer curve. And other papers has followed this approach for other countries. So, for example, Bai and others in 2016 have applied it for Argentina, Andres 2020 for Spain, Hurtgen and Drumkorf 2014 for Greece, and Hurtgen 2021 more recently for the Euro area. So this paper complements the state-dependent fiscal limit literature by estimating the fiscal limit for MENA countries, which is a task previously ignored in the literature. Another strand, which despite its importance, hasn't been really explored widely, which is basically the strand that assesses sustainability in MENA economies specifically. So most of the literature here examines public debt sustainability from using time series econometric tests. So this paper fills a gap in the literature by providing a more comprehensive analysis of debt sustainability through estimating the distribution of fiscal limit that arises endogenously for the countries. So to briefly explain the model I use, so basically the economy is populated by an infinite number of identical households, which choose their consumption and their leisure. So their utility is a function of their consumption, as well as they derive this utility from labor supply or utility from leisure. The household faces a budget constraint, which is given here. So here, tau T is the labor income tax, YT is income, ZT is government transfers, BT are one period bonds with a price QT, and delta T defines basically the default fraction on government debt. Output is produced with a very simple production function, which is a function of aggregate productivity, AT, that follows an AR1 process, and labor supply 1 minus LT. Now, in terms of how I specify the government, for non-oil exporting countries, the government basically finances lump sum transfers as well as government purchases by collecting distortionary income taxes, labor income taxes, and issues one-period government bonds. Now, for oil exporting economies, in addition, the government generates revenues from oil sales, which are given by ORT here, which also finance lump sum transfers as well as government purchases. Now, for tax revenues, I assume that tax revenues are raised based on a time varying tax rate, which basically increases as the level of government debt increases. Meanwhile, government purchases as well as oil revenues just follow stochastic processes. Now, it's important here to note that the details of the oil sector are not modeled. Instead, I treat oil revenues as this external transfer which directly accrues to the government without accounting for oil production or other factors employed in the sector. Despite the simplicity of this assumption, the framework basically sufficiently captures the impact of oil revenues on government budget, which is the focus of this paper. Now, for government transfers, these follow a Markov switching process, shifting between a stationary and an explosive regime, which basically, when they are in an explosive regime, this increases the likelihood of default risk. The government may default on a fraction of its debt, and default basically occurs if debt exceeds the B star here, which is the state-dependent fiscal limit that is drawn from a distribution which is from a conditional endogenous fiscal limit distribution. Now, how do I compute the state-dependent fiscal limit? So basically, it's the maximum level of debt that the government can service. It's defined basically as a discounted value of all future possible surpluses. And to compute this distribution, I follow by 2012 and use a Markov chain Monte Carlo simulation. So basically, for each simulation, future shocks to productivity, to government spending, to transfer regimes, and to oil revenues in the case of oil exporting economies are randomly drawn for 200 different periods, conditional on a starting state. And then the fiscal limit is computed as the present value of all the future surpluses that are generated. And I repeat this simulation 100,000 times, and then I get the conditional distribution for B star for both oil and non-oil exporting economies. And then I repeat this same process all over again for all the possible exogenous states within a discretized space. I calibrate the model at an annual frequency to a set of oil and non-oil exporting MENA economies using values basically either from related studies or matching the mean of some of the variables over the period 2000-2022. I'm not going to go into the details of the calibration, but they are all explained in the paper in details. So to move on to the results directly, so starting with the baseline case, in this case, I abstract from any stochastic variations in government transfers by setting ZT to be constant, the government transfer to be constant, and then I simulate the state-dependent distribution of the fiscal limit using the MCMC method. So this figure here on this slide shows the cumulative density function for the fiscal limit for non-oil exporting economies. So basically what these CDFs are, they illustrate the probability of sovereign default at different debt levels. And here I'm assuming that productivity is at its average level and government spending is at its average level. I also plot the debt to GDP ratio for each country in 2022 to provide basically a visual comparison between the actual debt level and the estimated debt thresholds. So starting with non-oil exporting economies, we can directly observe that the fiscal space varies widely across countries, which basically reflects the differences in their tax structures, in their government purchases, and in the interest rates on their debt. So for Egypt, for example, the debt to output ratio edges very closely to its estimated fiscal limit, which basically suggests that Egypt has very limited room for issuing a further debt without compromising its fiscal stability. Now, compared to Egypt, if we look at Jordan here, it has a larger fiscal space where its 2022 debt stood at around 94%, while its debt limit is around 119% at a 5% probability default. And this gives Jordan a fiscal space of about 25 percentage points of its GDP. Now, among the non-oil exporting MENA economies, Lebanon stands out with an exceptionally high debt-to-output ratio, which at 2022 far exceeded its fiscal limit or its debt limit at 83%. So Lebanon having already defaulted on its debt, its fiscal space is effectively negative, and its debt-to-output ratio needs to be reduced to roughly 1/3 of its current level to become sustainable. For Morocco, as we see here, it is in a better fiscal position with its 2022 debt at around 71% and its fiscal limit at around 140%. Tunisia has some fiscal space, so of around 44 percentage points roughly. And while this fiscal buffer offers some protection against immediate default risk, like there are some economic vulnerabilities in Tunisia, which raises the levels of sovereign debt and may hinder fiscal sustainability. Moving on to Turkey, we can see that it is in a fiscal position that appears to be relatively sustainable, with its 2022 debt to GDP ratios at around 31% and its debt limit at around 58%. So this gives it around 26 to 28 percentage points of fiscal space and suggests manageable risk of default under the current conditions. But it's important to note that Turkey faces high debt servicing costs due to the high interest rates. Now, turning on to oil exporting economies, we can see that the fiscal space is in general larger because of oil revenues, which provide a buffer against default risk. But at the same time, this increases the vulnerability of these economies to fluctuations in oil prices. So we can see that countries like Oman, Kuwait, Qatar have sustainable fiscal space. However, again, they depend heavily on oil revenues for financing their fiscal spending, and this highlights the importance of diversifying their economies to ensure long-term fiscal sustainability. Saudi Arabia also has ample fiscal space with its 2022 debt at around 24% and its fiscal limit all the way to 265%. And another country which stands out in terms of its fiscal resilience is the United Arab Emirates, which has a 2022 debt to GDP ratio of 32%, while its estimated fiscal limit is much higher at 296%. So again, Saudi Arabia and the UAE show a lot of fiscal strength, which reflects their oil wealth as well as their prudent fiscal management. And both countries have succeeded at maintaining low and sustainable debt to output levels. So changes in economic conditions can, of course, shift the Laffer curve of the economy and consequently can shift their fiscal distributions. So for instance, the maximum tax revenue would decrease with lower productivity, which translates into a shift into the left in the fiscal limit distribution. So what I do here is I assess how shocks to productivity of the economy would influence that sustainability in these economies. Starting with non-oil exporting economies, we see that negative productivity shocks, which are depicted in red here, would ultimately lead to a reduction in fiscal space considerably, and this poses a risk to public debt sustainability, particularly for countries with already high debt-to-output ratios. Meanwhile, for oil exporting economies, even though the size of productivity shocks are estimated to be larger than those of non-oil exporting economies, these countries have significant fiscal space, which is supported by their oil revenue generation and suggests they're more resilient to negative productivity shocks. When it comes to shocks to government spending, again, changes in government spending purchases will influence fiscal limits. So when the government increases its purchases without a rise in revenues, the fiscal surplus will fall and therefore the fiscal limit will also fall. So among the non-oil exporting MENA economies, Turkey and Jordan basically exhibit the highest variance in government purchase shocks, and this variance suggests that while a negative shock to government spending would expand their fiscal limit, a positive shock, that is an increase in government spending, would reduce their fiscal space. Meanwhile, oil exporting MENA economies face even larger shocks to government spending, and consequently their fiscal limit, as we see here, varies considerably when there is a shock to government purchases. And this reveals that even oil exporting economies can face potential risk from persistently high spending. And finally, in oil exporting economies, shocks to oil revenues constitute an yet additional factor or additional source of variation for their fiscal limit, as these economies depend heavily on oil to sustain their fiscal position. Now, these revenues are driven by fluctuations in both the price or the quantity of oil produced. Oil exporting economies heavily rely on revenues from oil for sustaining large fiscal buffers, which make their fiscal sustainability tied a lot to what happens in the global oil market, as can be seen in this diagram here. So to conclude very quickly, the unprecedented socioeconomic and political shocks of the last decade has impacted fiscal sustainability in the MENA region. What this paper does is it estimates the country-specific distributions of fiscal limits for non-oil exporting economies as well as oil exporting economies in the MENA region. I use a nonlinear DSGE model, which is calibrated to each country's economic fundamentals, productivity, as well as fiscal policies. The findings basically reveal that non-oil exporting MENA economies face tight fiscal spaces, highlighting the importance of fiscal reforms, which are mainly targeted at revenue generation, as well as expenditure control in order to sustain their debt levels. Meanwhile, oil exporting economies possess sustainable fiscal buffers, mainly due to oil revenues, but these large fiscal limits come with an inherent exposure to volatility in oil prices. Thank you so much for listening, and again, I look forward to receiving your feedback.
With my discussion of the papers now, and we will come back to this paper in particular also, which is the third paper. Let me go back to the, all right, maybe, okay, so, excuse me. So yes, this session is particularly interesting about it's a macro session, but we're talking about three papers: productivity, financial inclusion, and market power. They are all related, but there is also like a bigger umbrella topic here. So the plan is, after I discuss the contextualization and the three papers, the idea is, these papers have core structural challenges to inclusive and efficient growth in the MENA region and beyond, and they target a distinct macro axis for transformation. Fiscal sustainability under uncertainty, financial inclusion, and corporate market power, with Dr. Tohamy's paper, how it increases or changes with regulatory innovation. At the heart of these papers, there is a deeper theme, deeper inquiry. How can governments calibrate macroeconomic tools to unlock long-term productivity while safeguarding equity and resilience? So that is the overall arcing theme of the three papers. So what I will do is I will briefly present each paper's contribution, methodological insights, and their key results with some policy implications. And I'll follow this by a short comparative synthesis and questions for the room and for discussion. So let's start with the first paper, Market Power in the Middle East, by Drs. Korniyenko, Ahmed, Tohamy, and Weining. Now, this contribution of the first paper, as you have seen, it offers the first systematic empirical estimates of corporate markups in the Middle East using firm-level data. So that's like very micro data focused, and it bridges actually multiple literatures. There is an ongoing concern about the rising global markups in the literature, and also there are rentier state political economy that we observe, and tax policy as a competition tool, which we see it in the Gulf countries, and we also see in other countries too. In Turkey too, we have this same policy tool relatively recently. So innovatively, it examines especially the value-added tax as a de facto market disciplining instrument, an idea with important policy relevance in low capacity, especially low capacity antitrust environments, where the government has a low control over the market powers. So the methodology is, there are two actually complementary strategies. There's a production function approach. This is powerful, but it requires output elasticities and cost shares. The second approach, the additional approach, it assumes constant returns to scale, but that way it's also able to sidestep the elasticity estimation, which is very useful at this firm level data. So panel data for 13 MENA countries includes both listed and unlisted firms, and uses event studies staggered differences approach to evaluate the impact of value-added tax reforms between 2018 and 2022 on the Gulf Cooperation Council countries. And it also even offers important tests for robustness via alternative ways, inclusion and exclusion of Aramco, which is like a huge company, and foreign exchange exposure, as well as cross-method validation. So their key findings is that markups in MENA are higher than the US and the European Union, but declining, which is good news, especially post-2015, even before COVID. So we have this ongoing trend starting before COVID, which is good news. And this superstar firm, dynamics, which he talked about, is interesting. Its dynamics is observed in larger firms, higher markups. This is like what we see in other countries as well. And sectoral heterogeneity, especially in oil, it is the highest, but also utilities and services. But in construction sector, it is the lowest. These markups are lowest, so it is interesting. And no evidence of greedflation was found. In the Gulf Cooperation Council countries, the markups have been declining, like I said, and even following the inflationary shocks after COVID. And so that is also another good news. And value-added tax reform, especially Saudi Arabia's rate hike from 5% to 15%, which is a big jump, they lead to statistically significant decline in firm-level markups. So it shows that the policy is working. It's effective. So in terms of the policy implications, now, in environments like the Gulf countries, where the antitrust enforcement is weak, this is due to the government constraints, of course, value-added tax can act as a competitive discipline by reducing effectively reducing markups. The government increases the value of the tax, and the companies suddenly, they need to lower the price, otherwise they cannot compete with the local firms. So this is an effective strategy that can be used, and it is actually, it has dual benefits. Like first, for the local firms, which have difficulty in competing especially, but also like it is increased income for the government, which can indirectly help the population through infrastructure investments and other things. So it's a very important and interesting policy tool, and like I said, Turkey is also using it and other countries, so it is becoming more and more talked about. So markup decline, of course, translates to consumer welfare gains, especially through domestic firms which have low foreign exchange exposure. And there is a possible productivity boost also, again, reduced allocative inefficiency through, but maybe you'll do more studies on that. So I just to provide some both empirical and theoretical, to sharpen the paper a little bit more, just some little comments. And first of all, you could maybe, value-added tax as a competition policy is a novel and under-theorized. The theoretical part of it is like missing mostly. So maybe you can consider developing it further, maybe perhaps in a companion note or maybe in this paper, to explore the non-linearities, especially sectoral spillovers. We cannot observe them, like the more systematic, how it works. And also like maybe casual decomposition. What's the causal linkage? Maybe you could clarify more the disaggregation of value-added tax effects, and to what extent do they reflect policy adoption, rate changes, or enforcement dynamics? And also, thirdly, international benchmarking, comparisons with OECD countries or maybe other peer economies. Maybe this way you could contextualize the claim that MENA markups are high. Maybe a little more data on that, and maybe you could provide some color on sample representativeness. The relatively low construction markups. That is interesting, but maybe it can be maybe because it is missing large public or semi-public firms. This could be easily maybe discussed. So these are my some small constructive suggestions, so that we can now go ahead with the second paper, Fiscal Limits in the MENA region by Nadine Yamout, which we looked at. We watched her presentation through the video. So this is also interesting. It has a contribution in that it extends the BI's 2012 paper, an influential paper on fiscal limits concept, and it applies this to the underexplored MENA region, distinguishing between oil and non-oil economies. So the idea is, fiscal space is not just a deterministic ratio of debt to GDP ratio, like in general, but a probability distribution, and shaped by economic shocks and political constraints. So this distribution also is subject to change. So this is very interesting, and brings state contingent debt intolerance into the policy discourse. Especially critical for the post-COVID high debt environments, which the MENA countries are especially susceptible for. The methodology is the SGAE dynamic stochastic general equilibrium model with a stochastic fiscal limit defined as the maximum debt level, consistent with future fiscal solvency. We've seen the graphs she provided, allowing for uncertain political responses to rising debt. So this is an interesting estimation. So fiscal limits are estimated by simulating revenue responses to shocks, tax, transfer adjustment paths, and computing the cumulative distribution of sustainable debt level. And there are separate calibrations for oil exporting countries and non-oil exporting countries like Egypt and Lebanon and oil exporting countries such as Algeria, Saudi Arabia. Now, non-oil economies are more dependent on domestic taxation and transfers because they don't have this revenue. Oil exporting countries, on the other hand, are a little bit more relaxed because they have this external revenue buffers. So they both have different implications. And they use simulations of debt to GDP trajectories and defines the fiscal limit as the point where the present value of expected surpluses ceases to cover debt. So that's like the point of crisis. So they estimate that, which was very interesting. So their key finding was that oil-rich countries have, of course, higher fiscal space, which is to be expected, of course, but it is not unlimited. The fiscal limit shifts downward under oil price, so they are also, sensitive to the global oil prices. So the fiscal limit goes down under oil price volatility or, falling production. Non-oil countries, on the other hand, like Egypt and Lebanon, are close to or beyond their fiscal limits. We have seen this, especially in Egypt. They are in danger zone already. So in those countries, transfers, such as subsidies, like for social protection, are harder to adjust than capital expenditure. So they are more destabilizing to long-run sustainability. So tax capacity is critical, but most MENA countries face these institutional and political constraints on significant tax increases. And as for the policy implications, this basically shows that a purely technical fiscal rule, like a formula, can be misleading without accounting for this probability distribution of political willingness to adjust. So it's not, you cannot just apply a single formula, then that is, recipe for disaster. And, countries near their fiscal limits need to have some preemptive adjustment strategies, particularly, like I said, in transfers and pensions obligations. They have these reforms more seriously, And oil exporters, of course, they also need to not wait, and they should not delay reform under the illusion of fiscal abundance. Future energy transitions may sharply reduce their rents. So as for the constructive suggestions for the author, of course, we're going to transfer it to her. But, we could maybe say that, okay, we need maybe a comparative calibration could be nice, like a table comparing key parameters like tax elasticity, transfer responsibility across the country groups to see how this can be reproduced or, how we can see it more in detail. And uncertainty, like some maybe visualization, like another maybe graph or table to consider, how fiscal limit distributions like cumulative probability, like those graphs we couldn't see, but I'm sure they are available. So breaching the limits under baseline versus adverse different negative scenarios. Finally, thirdly, external feedback channels. For oil exporters, the model basically says that oil price leads to exchange rate, and it leads to inflation and tax capacity to capture the macro fiscal loops. Maybe more discussion on that. And finally, debt maturity and rollover risks. They can maybe clarify whether short-term debt dynamics and interest rate shocks are incorporated. Many crises, begin with, sudden rollover pressure, not like long horizon solvency problems. So those are my comments. And like I said, the third paper, unfortunately, they are not here today. But as a discussant, I will briefly summarize these key objectives and methods and findings based on their submitted paper to ERF. And my comments aim to support the authors, of course, revision process and ensure that the work receives some constructive feedback despite the unusual format we have here. So yeah, Nidhaleddine Ben Cheikh and Christophe Rault, the paper is entitled Financial Inclusion for Inclusive Growth, a structural analysis of debt sustainability. It's very interesting, actually. It tackles the central challenge in developed economies. Can financial inclusion advance inclusive growth? And financial inclusion is communication and information technology investments here, like the, financial inclusion, the number of ATMs, bank branches, the availability of credit, things like that, from the literatures, related to literature. So, but it moves beyond the binary treatment, using distributional and nonlinear modeling. They highlight when inclusion helps and when it harms, which is interesting because usually we think it is, useful, we have to do it, but, what they highlight here is, we have to do it, but we have to do it how? We have to do it, what is the right way to do it, right? So this is, I think, important because it actually shows you the concrete, policy pathway to follow. So I think it is, useful to have. They use a quantile regression and panel threshold modeling and identify heterogeneous and state-dependent effects on financial inclusion and governance and information and communication technology on growth, how growth is affected. So their methodology, they use 67 countries between 2010 and 2019, including developing, emerging, and high-income economies. So it's a very comprehensive study, actually. They use key variables such as inclusive growth. They proxy this by GDP per person employed. And financial inclusion is an index. This is a principal component analysis index, which they built. It is made from different variables like the ATMs, bank branches, accounts, loans, deposits. And they also have governance and information technology. That is also principal components analysis based. It's a composite indices. They have also two-stage empirical strategy here. They use a panel quantile regression based on Makada and Silva's 2019 paper. It captures tail heterogeneity, where the effects are strongest in low-growth countries. And panel threshold regression, they also use this to estimate the tipping points where inclusion begins to positively affect growth. Before that tipping point, as you'll see, is actually negatively affecting the growth, right? So their key finding is, financial inclusion improves inclusive growth only after a critical threshold, below which it may actually worsen inequality, which makes sense, like when the technology is introduced for the first time, it is beneficial, but, not everybody can access it, they cannot use it. So this is actually, it increases inequality. But then after a while, when the technology is adopted by the general population, this is when you really start to see the benefits as a country. So it is interesting that they can capture this with this model. And the information communication technology infrastructure is surprisingly has a negative effect at low levels of financial inclusion. Then this is, of course, likely due to digital exclusion, which is a well-known discussion. And governance quality here is, robustly positive across the distribution, emerging as the most consistent driver of inclusion. So the government has a very important role here, especially here. And they also find strong complementaries. Financial inclusion is more effective when paired with strong institutions and affordability of this technology. So the policy implications are, of course, many. A linear approach to financial inclusion can backfire. Okay, here it is. You can use it. The correct way to do this by the governments is that early stage interventions are required, and they must be accompanied by institutional reform and digital access policies, which are usually, unfortunately, overlooked, especially in our region. So but they are very crucial. And countries below the threshold need to sequence reforms very carefully, starting with affordability, education, and trust building. So these are what you need before just, trying to adopt the technology blindly. So for high inclusion countries, the technology, information and communication technology and finance integration can actually power inclusive productivity gains, but only with proper regulation. Again, with high inclusion countries, you also still need regulation. So the states, the government is very key here. I have some constructive suggestions to relate to them. First of all, this principal components analysis is not very clear in the paper, so they could maybe consider breaking down the index loadings so that we can see, the policymakers can see and diagnose which variables are like the important drivers of these findings. Secondly, robustness checks are needed. They need to add some tests using alternative inclusive growth proxies, like maybe Gini quintiles, or to triangulate the results. And interaction effects could be useful to have. Explore whether governance modifies the threshold effect of financial inclusion. How can this increase or decrease the institutional quality barrier? How can we lower the barrier with this? And some visualization, of course, policy visualization, like this results using surface plots or threshold response curves to improve the clarity and usability for, applied people, like policy designers, maybe. Okay, so these are the three papers, and as you have seen, they're all seemingly not very related, but actually they are also very, very related in terms of the ongoing transformation we face today, especially in the MENA region, but also beyond. So let's talk a little bit about the shared insights. What we have seen is in the three papers, and I think this is very important, this is like next generation studies, all three of the papers, because in all of them, non-linearity is central. In the classical economics, everything is more linear, but here you see that, for example, in the first paper, market power, the market power evolves endogenously and responds non-monotonically to the shocks, value-added tax shocks and policy shocks. In the second paper, the fiscal space is probabilistic, it's a distribution, it's not fixed. And in the third paper, financial inclusion can be observed only after thresholds. So these non-linearities are important, and it's actually the important thing to capture before any policy design. And institutions, the government, the institutions, governance quality, For example, regulatory gaps and space-owned enterprises, they shape market power. So government here key in paper one, but it's so it is in paper 2 and paper 3. In paper 2, fiscal solvency depends not only on the debt level, but also on political capacity, we've seen. And also on the third paper, we see that financial inclusion's effect also depends on the governance quality as well. And finally, policy tools have dual purpose here. So that is also interesting because traditionally, policy tools have a fixed, expected effect, but now we are beginning to see how they can be actually have multiple uses, and then you have to be very careful about how to deploy them, how to design them. You have to think about the consequences, not like on a linear or like more, but you have to be very careful. For example, in the first paper, value-added tax has a dual purpose. It reduces market power and also raises government revenue. So it's a very elegant dual-use tool, which is very useful, especially in this region. In the second paper, we have seen transfers. They are both social buffers and also as a fiscal liability. So they are both good and bad. And the third paper, information and communication technology investments are, they both inclusion policy, and they can also be a potential of actually exclusion, before. So they have to be also treated with care. So I have prepared only just one question for all the three papers. This is to encourage, reflection, and
maybe for you too also to think about these ideas and papers, and for Dr. Tohamy, and your theoretical model shows that value-added tax reduces markups only if demand is sufficiently elastic, right? So have you empirically tested or calibrated this elasticity of substitution, particularly for the sectors or firm types most affected with this? Well, the second and third paper authors are not here, but we can still offer these questions. For the second paper, we can we can maybe think about in terms of the uncertainties, facing MENA economies today. So, what roles could fiscal insurance mechanisms such as sovereign wealth funds, like the Arab Monetary Fund, regional stabilization funds, contingency credit lines, what is their role in supporting fiscal resilience during these shocks? Because the Arab countries, especially some of them, have these additional tools. Maybe that is something to think about. And thirdly, for the third paper, the results show that there is a threshold, which is interesting, about which growth effects become positive. But how feasible is it for the policymakers to monitor this threshold in practice? Given the index is a composite, principal components-based index, can it be translated into concrete targets, such as a certain number of ATMs per person, or ATM density, or like the certain percentage of mobile account usage? If they can also work on that, that will be more useful, I think, so that the policymakers may target these metrics. So let me open the floor to discussions. So how can we sequence macroeconomic reforms when fiscal buffers are limited, financial inclusion may backfire, and market structures are skewed or hard to regulate? So how should the governments balance precision targeting with policy? Maybe we can start with your, do you have any comments on the question? Or?
On my question. Yeah, so I mean, we haven't directly estimated the elasticity of substitution in our sample. The elasticity of substitution parameter is in micro frameworks. So yeah, the answer is we haven't calibrated, unfortunately, estimated the elasticity of substitution directly in our sample or calibrated it. In theoretical kind of micro 101, the elasticity of substitution parameter is directly linked to the markup parameter. So this is kind of this relationship that the price is equal to a markup multiplied by the marginal cost. That marginal cost multiplied by the markup. The markup is formed partly of this elasticity of substitution. And the conditions under which markups are higher than 1 are exactly the conditions under which there is sufficient elasticity in demand. So we haven't directly estimated it, but we're kind of comfortable with making that assumption. So that's, I think, kind of my immediate take on this. But we haven't directly estimated it, no. So, yeah.
Okay. Thank you very much. So, I mean, we can now, yes, please.
So, since Mr. Tohamy is here, my question is for you. The question is, have you, in your analysis, tried to use a dummy variable for private and public firms to see whether all of these markup effects differ between these two types of firms? And a related question, have you considered using information which is available and dummy variables for what we call politically connected firms and independent firms. I realized that IMF studies put a very straight limit on any kind of political analysis, but to the extent that IMF allows for that, I think it's important to see whether there is a difference between the effects for politically connected and non-connected firms in terms of markup effect. Thank you.
Well, thank you very much for your comment, both. So the primary sample and the sample that I presented is based on publicly listed firms. So those are kind of the firms that are traded in the stock markets, etc. Now, I understand the concern with private firms being slightly different and their behaviors being slightly different in certain instances. And so as part of that, we expanded our analysis to the Orbis database, which has some privately listed firms. There, we kind of conduct the analysis from scratch separately, and we don't merge the data sets and we don't append them together. Partly because Orbis has different variable definitions, and so we can't really one-to-one match them. And we also tried expanding, and this is current work that we're doing now, to the World Bank Enterprise Surveys to look at more kind of medium and small firms. So that's kind of with regards to the first question. With regards to the second question, so I'm not a fund employee anymore, so I guess I can say what I want. And I don't think they have a specific issue with using kind of this UN type measures for politically connected firms, or I guess Ashimoglu has a paper where he does similar stuff with Ahmed and Tariq Hassan. So this is kind of a feasible option, I think, that could be done. That is an interesting avenue. The issue is I don't have access to this data, unfortunately. Yeah, that's kind of the short reason why we don't have it. Thank you.
Okay. If we have, since okay.
Thank you very much. For the first paper, just a comment that some economic indicators, like to talk about the interference between, and the connection between the political on the field and the firms, some economic indicators are treated like political factors, especially in dictatorship. So even they dictate the value of, for example, inflation. For example, in Tunisia, the Tunisian case where I'm from and where I'm living now, 20 years ago, whatever happened locally or internationally, the inflation is constant. And the employment, the same thing for, it's considered like risk indicators. So this is, we don't have to neglect this really, especially also there is some bias in statistics and they fake, like in Greece, for example, because there is no independence between the national organization that provide the data and the government, and so it's really complicated to get clean data. Even when, for example, they exclude some from the basket, when they calculate the inflation, they exclude goods that experience inflation. So it's really this is the problem naturally for the data. So we have to get data cleaned or data from independent organizations, which is very difficult for the MENA case, I think. Thank you very much.
Mm-hmm. So, sure.
I mean, I second your concern. So this is that the inflation data that we're using is reported at the country level, and countries can kind of report whatever they want. Are we truly capturing? So with respect to the figure where we show kind of the inflationary shocks impact on market power, are we capturing the true effect of inflation, or are we capturing the measured inflationary effect, which is biased in some ways? And I think it's true that inflation is measured in a specific way that we have issues with, but it's these markup measures are measured at the firm level. So this is the firm reporting whether they're profitable or not. So to the extent that we believe that periods of higher inflation would still reflect as periods of higher inflation, maybe not to the same extent, so maybe not one-to-one, the prices increased by 1% and they reported an increase of 0.5%, then the effect, I think, is believable still. But yeah, thank you.
Mm-hmm. So these are, these are very useful, for with the, top economists in the room, and lots of feedback, high quality feedback you're receiving. So perfect the paper, hopefully. So are there any further comments, or not just for this paper, but you could take notes to send to the other authors of the other papers as well. So yes. Here.
This is more in response to your analysis of the mixed effect of financial inclusion. Introduction of, for example, telecommunication technology. Obviously, you cannot provide phones to everyone in the country at the same time. It's a gradual process, so those who get it first would have an advantage. But that is true of any technological change introduction process. Perhaps that's just the temporary initial effect. Mm-hmm. When we say there is a mixed effect, we have to differentiate between a new policy which continuously have mixed effect at the same time versus introduction of a new policy which has perhaps a negative effect first and then positive effect later on. So the second type are more tolerable because we understand that there is a period that the effect might be negative, but that's temporary, and then you have a shift to a more positive case. I think with respect to financial inclusion, those negative effects are really temporary dynamic effects that will go away as the technology diffusion is complete.
I agree with what
yes,
my colleague is saying.
I
agree with what he's saying. I would rather call it as market disruption, which is followed by market recalibration. Because I also agree saying it is mixed, because one would think that in the long term it also has mixed effects. But if it's in the short term, this is another analysis. And I come from a public policy practitioner perspective. So it shocks the policymaker if you tell him that it has negative effects. So we need to clarify sometimes the terminology. Thank you.
Yes, there's an important distinguish to make.
Because, excuse me, if the threshold is at the beginning, it differs than being in the medium term.
Mm-hmm.
The turning differs.
Yeah, as economists, we are already, familiar with J curves and is it? I think.
No, if you install a technology, the threshold is in the short term.
Yeah.
But after infusion in the whole economy, then it calibrates. This is different than saying that sometime in the medium term there will be a threshold. Okay. It differs. Okay. Because some policies, excuse me, also based on my studies and my practice, some policies take time to show their effect. Yeah. So the short term for a policy might be a medium term for another policy. So we need to be careful that what sector we are talking about, what characteristics of this intervention we're talking about, the disruption is in the medium term or in the long term. There's what we call, it's similar to the elasticity. Mm-hmm. So some disruptions are fast in the change, and some, their normal trend is slower. Thank you.
Yeah, definitely. I agree, and I don't need this though, right? So, we are familiar with the J curves and, in international trade. This is kind of similar, but I think the important thing is like the bandwidth,
right? Sometimes it's like very short, or sometimes it's like, as I tried to discuss a little bit, like mentioned a little earlier, they have to maybe make this more concrete and show the exact, policy tools, or like what to target for the policymakers, because, it makes sense to me, I think to you too, but, with this information, it's not just enough, because it can be confusing to the policymakers. So it needs a little bit more details and like some more concrete, prescriptions, and, how to approach these different types of technological shocks. So definitely, the idea is, definitely worth focusing on, but yeah, it needs more polish. So.
Should I have a comment on Nadine's?
Yes, please. Yeah. And I think we're mostly done. We have one more minute.
So yeah, I think Nadine's paper is amazing. Actually, it's a very cool analysis. I think what is specifically interesting that maybe could be done is kind of a study of the optimal decision on how much debt a government ought to take. So this is kind of a fiscal limit. So now Egypt, for example, is almost at its fiscal limit. Qatar is way below its fiscal limit. Should Qatar expand its debt to GDP ratio such that, and so that in the model that's kind of depends on the value of government expenditure, and the value of government expenditure in the model is the insurance or the inequality correction that the government provides through this transfer mechanism to the household. And that's the benefit. And the cost is obviously the fact that the government is taking money from the household, and that's reducing their welfare. And so kind of a study on where the optimal debt to GDP ratio is actually interesting and possible within her framework. It could also be the case that government spending is used not directly in an insurance way. It could be used in an innovation enhancing way. And so it might actually be useful if the government takes more deficit. The second thing that I had in mind is that the calibration uses often the announced average tax rates in the economies that were discussed. And a lot of these economies, especially the non-Gulf ones, and I'm not sure about Turkey, but there's a lot of kind of tax avoidance that happens. Egypt famously collects maybe 10 or 20% of what it could, or what it, the legal frameworks allow it to do. And so that is actually important in the modeling, because it could be that the fiscal limit of Egypt is way smaller. It's just that we're calibrating the tax limit, the tax ability that they're collecting to be a much higher level.
Okay, thank you for Dr. Tohamy also for his contribution. And this concludes our session for today. And thank you very much for this constructive comments and interesting session. So I hope to see you in the other sessions also.